Welcome to Visionary AI Partners. I'm your host, Ed Moran. Today we're joined by Evan Polaski, Director of Capital Rising at BlackGate Partners, a firm redefining on how retail and commercial real estate are acquired and managed. Evan brings years of experience in real estate investing and capital strategy, and we will explore how data, innovation, and AI are transforming the way firms like BlackGate identify opportunities and create value. Evan, welcome to Visionary AI Partners.
Thanks for having me, Ed. Happy to be here.
Evan, for listeners who might not be familiar, can you give us the big picture of what BlackGate Partners does and where your role fits within the company?
Yeah, so BlackGate Partners is a real estate investor. We buy and operate neighborhood retail shopping centers. So think where you go and pick up Chipotle and Starbucks, or head to the chiropractor, maybe the credit union type of shopping centers. We do this with outside investors. So my specific role is on the capital raising front. So bringing in outside investors that want to participate in the projects with us as we source and then ultimately manage, lease, and drive the value of the day-to-day operations.
And how are you or not using AI to help you with your goals of getting investors and so on and so forth?
Yeah, so as you're clearly seeing, and all of the listeners likely know, AI is touching basically every aspect of our lives. So within the company, there's the very basic stuff where we happen to use G Suite as our software package. So you have Gemini summaries on email chains that can be very helpful to just kind of hit those high level points. When I'm doing, Zoom meetings with potential investors, having it summarize and really help with reminding me of the follow-up, because I am a pen and paper kind of guy. I have my notebook right here, but I won't say you always miss something, but it's nice to have that double check of the things that I've written down and then hop back into there to make sure, because, it's not infallible, as everybody hears from the various both funny and sometimes concerning ways that AI might create some artifacts and not do what you're wanting it to do. So that's kind of like the very high level or very intro level. I then use it further because I'll host monthly webinars. So it has definitely helped more in creating those, creating outlines. There's still a lot of involvement and I think this is where AI really is. Like, I have a knowledge base of what I want to talk about. So when I'm giving it prompts to kind of help summarize and refine and provide different ideas, I almost use this like a brainstorming session, but I'm providing, paragraphs of just details that I want to hit on, different tenant sales I might want to be reporting on, or different ways that different investor profiles might be able to use the tax benefits of real estate. Just thinking of some that I've done in the past. It also helps. I use an app that I learned about at a conference called Gamma.app. But it's kind of a Canva-ish, but I can take my outline with data points that I'm getting and using ChatGPT to help supplement some of the research from the current system, where it's giving me actual, census data and graphs. It's giving me retailer sales as pulling from publicly traded filings on the SEC's website, different bits and pieces. And I can copy and paste that into Gamma to create a rough outline of an actual presentation. Again, it's not infallible, but it's taking hours of time off my work, because I consider myself a pretty good researcher. I tend to have a good understanding of like what I want to talk about in, say, these webinars, but I'm not a designer in particular. So having this app that can kind of lay out slides for me real quick, and then I can take, photos of BlackGate's actual shopping centers to layer in just to give a kind of like visual, really is helpful. So that's one thing. That's where I've been using it most, I would say, is some of that research, specifically in my role. There is another software package that we utilize. I mean, basically every company anymore is an AI company. So CoStar, I know, is using it, which is a big commercial real estate, whether you're multifamily, retail, where we use it, industrial, et cetera. It's trying to pull, they have a robust group of like personal researchers, because I've talked to several of them who are actually calling, trying to source owners and call them and say, hey, I see you bought the shopping center. What'd you actually pay for it? And trying to back into sales data, which can be sometimes obscured in this industry. But it still is helpful. It's like, again, in that kind of summary, refining, pulling out data points.
Do you find
there
the more detail you give it, the more precise and the more accurate you're?
Generally, yes. Well, I shouldn't say generally. Yes. For instance, and this is a very recent data point, but BlackGate focuses on neighborhood shopping centers, 30 to 50,000 square feet. We'll go a little bit smaller, maybe 20 to 50,000 square feet. But we're not buying kind of the next level up is the community centers, as they're called in the industry, but the grocery anchored shopping centers. So we don't have a Kroger as a tenant in our portfolio. We look for those kind of standalone type of shopping centers. Now, when I was doing a webinar literally last week focused on why necessity-based retail is, resilient through good economies and bad, or resilient through recessions, the first round of that, because I was just kind of typing away and I'm in my mind thinking, here's what we buy. But then I look at the outline and I'm kind of running through the presentation. I'm like, oh no, this is pulling Kroger sales. It's really hitting into the grocery anchored space, which is not inaccurate data, but it's less catered to what I actually needed. But then with a simple revision of the prompt saying, hey, take out the grocery focus, it doesn't need to be completely excluded. I don't think that would be accurate. But, don't center this whole thing around grocery sales data. And, 5 minutes later had different sets of sales comps, different same store sales, again, pulling from public companies, SEC filings, hitting on tenant bases that are present in our shopping centers, the dollar stores, the quick service restaurants, et cetera, and kind of refined all of that within 5 to 10 minutes. Well, it refined it in much faster than that. But by the time I reviewed it and looked through it and, a couple refining prompts there, the better. The other piece that I've used it for, and this is more out of like fun family stuff, my son and his two friends started a kids magic YouTube channel where they'll like go into their room, because the three of them are two brothers, and have fun with doing magic tricks. And so I'll use ChatGPT to create thumbnails. Like they'll kind of have an idea of like what picture they want, and they'll film it within it, and then we'll screen capture it and do that. But the most telling artifact in that is it misspells words all the time. It puts gibberish into anywhere where you want actual text. So that would be another, I have to tell it specifically, put these words in there. And then sometimes it still even takes 2 or 3 more prompts to like get it to spell the word three, THREE correctly in that image that is helping create.
We have like every week there's something new dropping out.
Yeah.
That is, they're just getting better, more accurate, learning. So BlackGate, you were just talking about some of the retail space that the value add centers that you guys deal with. What makes those types of assets appealing right now, coming from COVID, and how do you identify these properties for the most upside?
The thing I love about real estate, which is a little bit of true with, I'd say blue collar work in general, is it's still very much a people sport, so yes, we're using AI and I think this is where a lot of companies are, we're using it to help, refine, remodel kind of processes internally. But at a high level, we have a director of acquisitions who's out in the market every day, talking with brokers, uncovering direct to, or I think he used it some to find actual owners because a lot of this is
Meaning AI. Is he using AI?
there are tools that kind of help track down. Yes, and again, it's more of like it calls itself AI. It's data mining. If I really want to label it more accurately, but in this case, because most commercial real estate is owned under LLCs, those LLCs are created by sometimes by attorneys. Sometimes if it's a larger operator, they might have in-house, and then you can start to like find the LLC, find the registered address, backtrack that address into like, okay, that company X is based there too. They are likely the owner because that's where all the legal filings point back to. But so there are tools out there that I market themselves as AI that are utilizing that. But ultimately, he's finding the deals. He's throwing all the financial data into our underwriting model. So there is some, again, kind of revision, pulling of data through, I believe, some AI services where you can dump rent rolls with all the different leases, rent terms, when it expires, whether they're triple net or gross or modified triple net, et cetera, all industry lingo, and helping, take out some of that administrative work, which would, I remember being in the industry close to 20 years ago, and we'd get a rent roll and the acquisitions guys the underwriters would have to take it out of PDF and just manually type it back into Excel. So it's definitely helping clean up some of those processes. Again, still spot checking because nothing comes in a uniform way between deal to deal. It helps with, so that's kind of like the direct sourcing of stuff. But then there's demographic reports and tenant sales data. There's a service in the retail industry called Placer.ai, which tries to back into how each tenant is performing in that specific center. So it doesn't always give you actual data. Sometimes you will get tenant sales, for instance, but that's coming from the seller. But it'll say, I've had brokers pull some for deals that I've looked at personally, where it's got a Walmart as one of the anchors, as one of the tenants in the shopping center. And somehow through the magic of AI, because I'm not an AI guy, Placer will go and be like, oh, that's a bottom 25% performing Walmart for this market or nationally or something. So then you start to think, okay, well, if it's in the bottom quartile, bottom 10% of performance out of the whole portfolio, and they're coming up for renewal in 3 years, that's a ripe piece of real estate for them to just not renew. And now I'm stuck with a dark or a vacant Walmart. And what am I going to do with that? So you can use it that way. Or alternatively, oh, this is a top 10, top 10% performer. They're very likely going to renew. Oh, they also reported direct sales data, and I can kind of combine those two pieces of data. So that's helping that's on the acquisition side. On the operation side, where the value add really comes from, a lot of the deals that we look for are about 20% vacant. So we're buying cash flowing assets day one, but where we can create that upside through our internal leasing and focus and grow that way. So that Placer data as well will help, or Placer.ai will kind of do your whole market analysis for you, from what I understand. Because again, I'm not directly in the leasing side. I know a little bit about it, but it'll say like, yeah, there's only one bank within 3 miles of this shopping center. Maybe you should be targeting banks to get into this shopping center. It's kind of looking at the typical, this one's catered to retail. So it's looking at the typical tenant profile. What are good, what is it? If you go to these suburban strip centers, there's a Supercuts, there's a local Mexican restaurant, there's a pizza place, there's a something else, and you kind of have the same lineup of tenants because they do complement each other pretty well. And so it just takes some of that, like the research side of it, like, well, where is the next closest X? Whether, let's talk banks, Wells Fargo, PNC, Fifth Third. Can we fit a local credit union in here? Because there's not a lot of data, and then you can refine it deeper. Not that the real estate guys at those companies that are ultimately repping them don't know this, but then it's all right. Well, your next closest location is 5 miles. So you're not going to cannibalize. Most people aren't going to drive 5 miles for a bank. And I'm making up data, but there are these retailers have, especially the bigger ones, have this kind of knowledge in their database of like, how close do we need to have each bank location in today's market?
You're essentially using that data to essentially find clients that could kind of boost where you're at because there's a need, and the
Yeah.
data is telling you that.
Yeah. And particularly on the national regional tenant side, but it helps with the local tenants. We do local tenant leasing, whether it be, doesn't seem to be quite as popular as it once was, but like the tanning salons or something like that,
Yeah.
which tend to be much more one-off, or they own, 3 or 4 locations, but they don't have corporate real estate. They're not Chipotle, where it's like, we've got a corporate real estate team.
Yeah.
And then below the main team, like the relationship managers, you've got all the analysts who are watching day-to-day sales. When is everything coming and going? And, all right, how much parking do we need for that store? Because we know that our store will drive this much traffic at this hour of the day. Like, the nationals know that level of detail.
Okay.
The locals don't, but you can still use it to help convince, as someone is out there shopping for retail space, using that local tanning salon, for instance, they're not just looking at your center, because we're not buying in rural areas where there's only one shopping center and they're either going to open there or not open. We own in Columbus, Ohio, Minneapolis, etc.
You go, what do you base, like around what, 50,000 and up type, where you're kind of searching? Where's your criteria for?
Well, we buy shopping centers that are smaller than 50,000 square feet. And then is that what you're asking about?
That's a good another question.
Okay.
You could answer that one. I meant population wise.
Oh,
because you were talking about you're not going like into a
yeah. So
area.
typically we'll want within a 3-mile radius about 100,000 people. So we're suburban, but we're not. It's still pretty dense suburbs. For instance, we own a shopping center, for any of your listeners who know the market, in Polaris in Columbus. We have a shopping center. I'm based in Cincinnati, in Mason, so a kind of northern suburb of Cincinnati area. We've owned a couple on like the Missouri side of St. Louis, Kansas City, not St. Louis. But again, when you go too far out, like those population densities are what drive your traffic. There's also income numbers that we're looking at that we don't really get from AI, because there's groups that really like those, only the class A $150,000 a year average household income in ultra dense type areas. And they're going to pay, a premium to get that, but that's the niche that they fill. And then you have the opposite, who are like, yeah, we want the very kind of low income areas. Our expertise lies in the operations there. We view ourselves as kind of like middle America, 50,000 up household incomes. We have some that are much higher than that, north of 100,000, but ultimately we kind of play in that game where your demographics, and ultimately it comes down to, we know the demographics because we know the tenants that we want in this center, and the tenants know who their customer is. So like ultimately it comes down to like Supercuts goes into, we'll only go to shopping centers with X population, X average household income, X miles from their next local store. And they take 1,800 square feet, and like, that's that. And when you vary from that within their spectrum, then you start to get into, okay, at this shopping center, they're going to pay, they're just plugging in formulas. They will pay $15 a square foot for that demographic. They will pay $30 a square foot for that demographic kind of play.
How many states are you guys in?
We are in Ohio, Kentucky, Minnesota, Illinois. We sold our 2 deals in Missouri, but like the Kansas City area. But so we've been in 5 states. We look for assets we were founded in Columbus. The office, while I work out of Cincinnati, the offices are in Columbus. So we look for other cities that are comparable type cities to Columbus, Ohio. So the suburbs of Chicago, the suburbs of Kansas City, Minneapolis, where you have cities that people know that aren't going anywhere. Again, we're not going into like the rural areas. And then from there, we're looking more sub-market. Is there population growth? What are the incomes? What's the density already? Type of plays.
How is the market that you're dealing with there in the Midwest now?
It's still a pretty tight real estate market. It's not as bad as it once was in 21, 22 when kind of everything was peaking and interest rates were still very low. So it's loosened up a little bit, but there's still a lot of demand for the types of assets that we're buying. So, the deal that we currently have under contract, we got it because it fell out of contract with a large publicly traded REIT who sort of threw it under contract because it fit their buy box. They have, they're making $200 million a year free cash flow to buy assets all cash. But they're buying at such a scale that they walked away from it once they actually toured the property. And it was interesting. This story is funny because you would think they would use AI to at least do a street view search of it, but it has standalone retail on one side, but we're buying the whole strip, and then half of the retail center that's divided by the entry to the parking lot has condos above it. So half of it feels a little more mixed use. And that's why they walked away from it, from what I've heard. They just didn't realize there was a mixed use component, even though they're not actually buying the condos above it. They're buying just the retail. Because it's a different tenant base. It's a different play. And you would think, did you not even do a basic Google Street View? Like, it shows up accurately on the Street View. But they, from what we heard from the brokers, like, they had it under contract. As soon as they did their site visit, they realized that and walked away. And it's like, again, like, way to throw good money after bad. You paid somebody to fly up there and travel the market just to realize that something was wrong with it that you wouldn't buy, that you could have found well before then. But I guess that's the issue of doing things at scale. Do
you guys get involved in mixed use?
We don't own any. This is the closest to mixed use that we do. And again, this is condoed out. So all the condos above it are sold. Technically, it's a part of the HOA, but we don't own the residential above it. We own the land and the retail itself.
Okay.
And so
you're not doing property management for that.
Yeah, we're not leasing out the apartments above it. They're not apartments anyways, but no, and we don't even run the HOA. Once we close on this deal, we are a member of the HOA. We have a pretty heavy vote in it because we own some of the most valuable real estate on it.
Right.
But yeah, it's a little different play. But typically we're buying just, again, your very generic suburban. I keep using these tenant names. We have more than these tenants, but Starbucks on one end, Chipotle on the other end, a dental shop, a chiropractor in the middle, an orthodontist, a karate studio, and that's it. Surface lot, drive up, get your things done, and drive away.
These aren't your mall types.
No, these are smaller. Like I said, as low as we go is 20,000 square feet. That'll typically have, again, it depends on the tenant, but I'd say on the big end, if you have a dollar store and a pretty good sized restaurant, you might have five tenants in that space. Typically, you'll probably have eight-ish, 8 to 10 in one of our typical, 30 to 40,000 square foot shopping centers.
Coming back to AI, with what's going on with it and how you're using it, are there any ways that you would like that you're having an issue in a certain area in your business? If you could solve one issue, what would it be?
Very firsthand, since I'm on this side, it's identifying accredited investors who are interested in investing in real estate, which, again, is a tall ask, but it comes more from the marketing side of, filtering down the universe, finding ways to, where do these people spend their time. So these are the high income earners, high net worth, but individuals that I'm interacting with day to day. So it's trying to find them, and then I don't really know how AI would do this, but this is why I'm not in AI. That's why I'm in like the boring industry of real estate. I have a stepbrother who is in kind of like a tech-y type world, VC funded company. And he's out there, like, he lives in LA, but he's up meeting, this is an anecdote, meeting with people, employee number 5 at Tesla who took their stock buyout and like owns a VC firm now with all their personal money. And he's just like, I mean, the scale that they think of. And I'm like, it's funny because I hear that and I'm just like, that is a bunch of people blowing smoke. But somehow they have made a lot of money and they're investing in deals that are going to make more money, hopefully. Some will fizzle and burn out. But the moral of the story is, I don't think big enough for it was the point of bringing that up. But it really is, since my job is, capital raising, it's still very much a personal business that I would love to find efficient ways to scale faster. And almost any real estate company, everyone that I've worked for, every person I've met that has worked for other real estate companies, whether an employee role or a general partner, principal type role, money is almost always the limiting factor. We would buy more shopping centers if we had more money to spend. And that creates its own issues, admittedly. But ultimately, having that database is very valuable to, like, I want to find, $300,000 a year earners with $5 million net worths who, have tried real estate a little bit or know that it's a valuable asset class to diversify their portfolio and can invest 50 to 100K a year here and there. But then I have thousands of those people.
What criteria, what are you particularly looking, what type of person, like, in what value range are you looking at that they could have?
So our typical investor is $100,000. Our minimum is $50,000. We don't foresee that changing, that minimum. But then, we have investors who have written $500,000 checks into a deal. So it runs a pretty wide gamut, but ultimately they have to be accredited per the SEC's definition, which is $200,000 a year individual. Currently, there's talks of it changing. There's talks of it changing both ways, actually, either getting higher and more stringent or getting relaxed and allowing more people access to these types of investments. But as of right now, $200,000 a year individual, $300,000 a year as a couple over the last 2 years, or $1 million net worth, not including your primary residence. So again, we use marketing agencies here and there, and at other companies, I've worked with marketing agencies who have tried to, they're more versed in meta marketing and ideal client profile type stuff. And I know they're refining that down because that is a common definition. But over my years in these types of deals, or the various types of deals that I've worked on, I would say the very typical investor over the thousands I've worked with over the years in this kind of like individual investor, accredited investor, high net worth investor type space makes about $300,000 a year, has a $500,000 net worth, has done a little bit of real estate directly, like they've had an Airbnb, or maybe they still do. Maybe they've owned a couple rentals over the years and realized, hey, this is kind of a lot of work, but they see the value in real estate that way. And a lot of this is private information. So it's like the AI side is that fine balance that I play in personally, where I'm like, I don't want all my financial information out in the world, but I'd love it if everybody else did. And I could filter and refine and identify and nail down. But that's why marketing companies charge what they charge in this space, because you can just like kind of who someone voted for and all the political side, like you can make assumptions. Oh, you live in this zip code. Well, this zip code has average household value of $1 million. Well, if you live in an average $1 million house, you probably make at least $250,000 a year, if not more. And you probably have other investments. And if you have MD, on the handle of your LinkedIn profile, you are a physician. You probably make X. So like you can kind of back into assumptions there. But then it's trying to find then it gets down to the typical marketing and sales side of like, what is that person's pain point? When are they online? When can I talk to them and reach them with either this advertisement or some other not overly intrusive kind of way of approaching them to start building a relationship, to build trust, to then hopefully they will invest at some point.
How long do you guys typically buy and hold?
Each deal is going to be unique. I'd say 3 to 5 years are typical.
Is the like average?
Yeah. We try to get out as, there's some deals that we want to hold kind of forever, but we can't because we have investors and we've told them it's going to be, anticipated 4-year hold. But I will, we try to run a range because, my exact talking points to investors is always, we will always sell when we can maximize your return, but we never want to be pinned down to, we're only going to hold this deal 2 years. Like we'd love to operate it, get it all, get it filled, get it sold and be out of it. And that's our intent. But if in 2 years, the market is worse than it is today, we don't want to tell you one thing and then do the other. So you try to build in some flexibility in your expectations there.
Yeah. There's always the ups and downs in the political environments, and there's so many factors.
Yeah. And I mean, I'm not trying to imply I'm some old guy. I'm in my early to mid 40s, but it's funny because I hear it and I talk to investors every single day, and you find some who are kind of like, now's a great time to buy it. Like your next phone call will be like, this is terrible. Like I would never buy now. I just kind of want to start building the pipeline for 2 years when things settle down. I'm like, I've been working in real estate for 18 years now or longer. And I'm not saying that's, I'm not trying to compare myself to the 60-year-old who's been in it for 40 years, but
that's a pretty good long time though.
Yeah. But if it's not like, oh, we're coming up for an election. I mean, we have an election in 14 days. I know it's not a big one. It's not the midterms or the presidential one, but I'm hearing all the radio, I'm driving around my little village here, and it's like vote for city council or village council people. There's always going to be something that's going to impact. Interest rates go up, and now you're kind of risk off because your portfolio is going down, your stock portfolio, and that's what you're going to tap into to get into real estate. But then when interest rates were going down through COVID, you wouldn't sell because you're watching your stock portfolio go through the roof. And I'm not going to lie, like real estate will never hit Bitcoin type returns, but it's going to be like steady Eddie, just jump along, or not jump along, but like kind of just grind along over and over. And yeah, we'll see the peaks and valleys of it. And there'll be times where you're like, oh, why didn't I buy then? Well, because you were scared then in reality. And the biggest thing, and I think this is true with, as I'm staying on this tangent, is especially in my role, I look back at the financial crisis and like some of those home run deals you could do. You were looking, whether it's the single families that I was buying for $20,000 out of foreclosure personally, or the company I was working for back then that bought a foreclosed shopping center, like a power center development that they couldn't just fill. They got a lot of it filled, but they were underwater coming out of 2006. They bought in 2008 for like $40 million, filled some more of the vacancies, went out, I think it was like 2 years later, 3 years later, and refinanced and got an $80 million loan. They bought it for 40 and they got $80 million in loans. Now, again, there's outside investors that shared that and everything else, but like that was just the loan and they still owned the asset and there's still equity in the bank's eyes and in reality too in that asset. So it's like they tripled the value in 3 years, partly because they bought it at the right time in a majorly distressed market. But the flip side is, and they had money available to them given their scale and when they had actually taken commitments. But a lot of times when I've talked to brokers, it's like, And I saw this in 2021 in a similar type role that I'm in today. When investors all are flooding into the market, yes, get me in. Here's 100K. Like, buy me a shopping center, buy me an apartment complex. Like, I'm investing. Let's just make money hand over fist. Well, guess what? The deals aren't great. And most of them have lost a lot of money or just not performed very well when you're buying in that kind of market. And now we're in that kind of lull. I think there might be a little more downside depending on the asset class to come. But it's like now it's trying to pull teeth to get somebody to part with a $50,000 check when in 2021 I was admittedly an order taker. Just people would ring me up, and if they didn't want to invest, I'm like, that's cool. I've got 8 more calls today. And then tomorrow I have 10 calls with potential investors. So like, invest, don't invest, I don't care. Because we're going to fill this up either way with admittedly minimal effort. So again, it's just the nature of the market cycles.
Seeing the markets and your company where it is today, where do you guys see yourself then? Just going right into the next 6 to 12 months. Where is BlackGate going?
Yeah, I call us kind of a steady Eddie type player. Yes, we want to raise more money. Yes, we want to buy more shopping centers, but we're a pretty lean company. We've got 7 people total, and that's the 3 principals and then 4 others. So next year, our target's to probably buy $25 million worth of assets, raise, $9 $10 million of equity. And we think that's very achievable, but we also have very strict acquisition criteria. So while we have, like many companies, you kind of have like your guardrails. Here's where we want to be moving. One reason that, one of the factors that drew me to BlackGate in general, I've liked retail. I've started my career in a retail operator. And while I've worked with others, it's always had a soft spot in my heart. We put significant amounts of our own money into every deal. And typically, not always, but typically we are the largest investor in our own deals. And I've worked with groups and invested in other groups where that is not the case for various reasons. But because of that, because, we're signing personal guarantees on the loans, we as in the principals, we are, we charge the standard fees that these types of investments typically carry. We're kind of middle to lower end of the market. I've seen some very egregious groups that charge, just astronomical fees, and they're making way more money than they should just to buy the deal, let alone how the deal operates. Mm-hmm. But for us, we only want to buy deals that we want to invest in. And we're not at a scale yet where we can just self-fund our deals. And all right, we're going to find $20 million of assets, and we're bringing in $10 million a year. And just, I'll say collectively, the 7 of us or whoever it becomes, because I am an investor myself, like, we'll just fund it ourselves. Great. We're making so much money. Why would we share this with anybody else? And again, I think there's always that ability to have outside investors, but right now let's just be.
Do you think that gives you an advantage that you guys are?
It does. Yes. I mean, from my very personal point of view, I won't even call it a disadvantage. The challenge with my job is just getting the name out there, because we've always just done it through kind of friends and family, which a lot of groups do. But you start to, especially in this uncertain time, which feels more uncertain than it did a few years ago, you find a great deal and you go back to those friends and family, and there's like, I just don't. Or, in this case, we bought a deal middle of the year, which was our biggest raise ever, is before I'd started with them. Not that I think it would have changed the outcome, but it's kind of like, people only have so much money. Like, even if you're a high net worth individual, you're making $300,000, $400,000, $500,000, $600,000 a year, which is more than most, a vast majority of the American population. It is, if you go back to them time and time again, hey, all right, I'll do $100,000. That was a great deal. And then you go back 3 months later, hey, you want to do another $100,000? Most people are like, I make $500,000 a year before taxes. I don't have another $100,000. I can't invest $200K with you this year. So that's part of my role. And back to some of my pain points with AI is like, how do I identify, target, find, and solve specific pain point. We have the general pain point of I want to be in retail, but like to my AI question. But again, because of that, the limitations on the capital side, we are very strategic with what we buy, which deals we kill. Like we had 2 investment committee meetings last week and we killed both of the deals. And one was because it was a new market. It was too small of a deal. There's 15,000 square feet in a market we've not gone into. We like the market, but to enter a new market for a really small deal isn't worth the risk, even though the returns penciled out to pretty solid. And then another deal, kind of similar thing. I'm trying to remember exactly, but it was just it was like a $6 million raise. And it was like, we're just getting through this one. Like we need to give it some time and start building the network more before we can do that type of raise, given that we've already raised, $7 million this year.
Excellent. That was a lot of great information. Is there anything you would like, before we finish, to promote that you guys have going on, or anything?
I always encourage people, if they're listening to this and they're interested even in just learning more about retail real estate investing, kind of follow me on LinkedIn, connect with me on LinkedIn. And I have a relatively unique name. So I think I'm the only one out there. I am active on LinkedIn, obviously, which is how you, Ed, and Beth found me, and really just try to share a lot of content of like what I see in the market, what BlackGate is doing specifically. And from there, we talked a lot about accredited investors. If you're an accredited investor and you're interested in learning more about our deals, reach out to me through LinkedIn or schedule a call with me, which is available on LinkedIn. And we can start talking about it. But it's, similar to you. I've worked a long time in real estate. I've owned single family homes. My wife and I had a short-term rental once, learned a lot of lessons. It did okay. We made money off of it, but it's like, this is not worth the effort. And if we did it again, we would tweak many things. I've worked in retail and multifamily. I've worked on industrial deals. I'm an LP myself in a handful of deals. So it's like, I've seen a lot within the retail or within the real estate world, both as the passive investor, the active investor, the employee of a larger general partner that's running these deals. So have, I think, a relatively unique insight because of that.
Very much so. Evan, thanks for joining us today and for sharing your perspective on how data, technology, and human insight are reshaping the future of real estate investment. And to the listeners, thank you for tuning in to another episode of Visionary AI Partners. If you enjoyed today's conversation, subscribe to the channel, like the video, and share it with others exploring innovation in their own field. I'm Ed Moran, reminding you, stay visionary.